good morning to everyone. It's an extreme honor to kick off day 2 of UNICON. And this morning, the Masterclass session is going to be talking about some basics of funding and going to be exploring what are the different financing options for startup companies. If you are a founder, you are a student, you're an entrepreneur, and you have an idea, right? How do you then get these ideas executed? So we're going to talk about it. What are the different types of funding available across that whole journey? Number one, most important, funding, right? The importance of funding for business. Without money, the machine of commerce does not run. So realize that money is actually the lubricant and the fuel to make everything positive, right? Whether you want to design a product, you want to produce it, you want to market it, everything requires funding as well. And we're going to talk a little bit about how companies, entrepreneurs raise funding across that different growth journey. And the idea really is to build yourself and your company into one of these iconic figures, right? Whether you are Apple, your Razer, or your Grab, right? All these companies started from a very small little entity like yourself with a piece of paper and an idea. A few very budding young entrepreneurs that knows nothing about business, and eventually they get to the end point. So here is a very basic funding timeline for startups. From the start to the finish, at different times in your growth journey, you will be raising and looking for different sorts of investors to be putting money into your business. Okay, let's start from the left-hand side. First of all, really up in the game is really skin in the game, right? And what this means really is that for you as an entrepreneur, any investor that wants to invest in your company will require you to have some monetary investment into the business itself. And precisely that's the game, right? Not only are you executing the idea, but you also have your own personal wealth in there as well, right? So number one, very importantly, skin in the game. And there are many people who have done that, many successful founders and startup founders who have gotten through that journey either with or without venture capital investor, angel investor. Some of them have even taken it all the way without external funding as well. And here in December, I came across this article which was very inspiring, right? This Czech startup founder actually did not raise any external funding, and he was able to build a unicorn out of that whole business idea without external funding. So it is possible. And there are many more other companies who have bootstrapped their way into billion-dollar valuation, and these are some of the iconic companies out there. Crowdfunding, right? Crowdfunding is another opportunity for you to tap into an early stage investment by telling the crowd how exciting your product is and convincing them to actually invest into your company or your idea, right? And I think what many founders have actually failed to take advantage of are non-dilutive grants. And in Singapore, right here in our homeland, there is a lot of non-dilutive grants that's actually been given. There's this entity called Startup SG that provides all sorts of funding for different stage of a founder's journey. And please, by all means, go and take a look at the website when you have time and try and tap on as much of the non-dilutive grants as possible. Angels. Angels are very important in the whole startup ecosystem. They are the catalyst of risk capital in a very early stage company where there's no product at all, it's just an idea. And these angels who have made their money, their wealth, from their previous successes, are now willing to invest into companies, that will follow their footsteps, right? But angels are very, very seclusive. It's not easy to find them. They don't have a website, and typically it's through getting through, connections and network to get to these angels as well. So what's the difference between an angel and the venture capitalist? We'll talk about the VCs later on, but an angel basically have a smaller check size when they invest into a company. And a VC is a more institutionalized, a more formal fund structure, right? And they can also cut a bigger check for you at a later stage of your startup journey. Now, we've talked about right from the beginning, personal savings, your skin in the game. You can use crowdfunding. You can use non-dilutive grants. What about once you get to that part of it, right? After the angels has put in their risk capital, what next, right? So let's explore a little bit about venture capital investment. And this can be in the form of debt or equity. So what are the ideal conditions for equity financing? Typically, you have a business model that's unique, that's unpredictable, and you're going to shake the whole industry up, right? So one very good example is Grab. Your company will exhibit high growth, right? You know, week-on-week growth, month-on-month growth, year-on-year growth, spectacular type of growth. You know, 1 million of revenue in the first year, 10 million in the second year, 100 million in the third year, something along those lines. Connections, right? You and your management team, your other co-founders have some prior business success or some form of investor connection as well. And at the same time, you're okay with giving up some equity, right? Maybe between 20-30% of the business with each funding round. So what happens when you take in venture equity, right? When you take in venture equity, there's some form of dilution, and I will explain it briefly to you right now. So if you look at the pie chart on the left, that's pre-dilution, right? That's when you and maybe a co-founder that you have brought on board, you guys own 50% of the company each. Okay? Once you start bringing in an investor, whether they're angel or whether they are venture capital fund, on the pie chart on the right shows that you're giving up a certain proportion of the company by diluting the two founders. Okay? Very simple mechanism. And here it's a little bit more extensive description of it. So from the idea stage, you own 100%. You and your co-founder will then split the company to half. As you bring some family, friends, and some fools into the company as well, you give up a bit more of the company. And as you raise a seed round, a venture capital round, and even when you get to the eventual IPO round, then you will start owning less of the company, but the company becomes much, much more valuable. So venture capital has been a very important part and a catalyst for innovation and startup journey. And I just wanted to illustrate that even last year, right, in a very challenging pandemic year, funding has hit a high record. And the reason is because in a crisis, there's more innovation, there's more people starting up their own company as well. And that's the reason why funding hasn't slowed down, right, despite the crisis. If you take a look at it globally, in the last quarter of 2020, more than 4,000 deals have been invested, 80.6 billion globally, right, spread across Asia, North America, and Europe. And if we take a look at some of the funding that's been happening in Southeast Asia, it's not slowed down, right? Quarter on quarter, across Singapore, Indonesia, and the rest of Southeast Asia, funding has been pretty resilient. So investors have always been on the lookout for good companies, even though there's a crisis happening. Right? So now we've talked a little bit about the equity part of things. What about debt? Right? So debt for startups, isn't that a very interesting point, right? Because most of the companies will not qualify for debt, right? And so when it comes to talking about debt for startup, that really intrigues a lot of people, and including myself, right? When I first started doing venture debt for DBS Bank. So venture debt, it's a very specialized form of debt financing, right? It's provided by specialist lenders. So you will not find any typical banks out there or any other typical lenders out there providing this form of financing. And it's specifically geared towards high growth companies and in particular startup companies. And very simply put it, venture debt 101, right? It's a form of straight debt, meaning that it's a debt that you have to repay, right? So it doesn't convert to any form of the equity in the company. and the lender gets some equity warrants in that process, right? That kind of defray some of their risk in the company as well. And whether you're a startup company, you're an SME, right, or you're a large corporate, there's always a need and there's always a judicious use of debt and equity in the company. It's just that debt is not available for very early stage companies, but as you grow your company, now be aware that venture debt is actually available for you to tap on as well, right? And there are different forms of debt usage, right? Whether is it CapEx, inventory, working capital needs, R&D innovation. It all depends on how you spend your money and how you balances out the cost of capital in the company by raising the right proportion of equity and debt. And the benefits for companies can be tremendous if you know how to use it. It can extend your cash runway if you bring in venture debt at the right moment. It can lower your equity dilution as well. It can, and it's very, venture debt is the same flexible form of capital that can supercharge your growth like equity. And at the end of the day, if you use it correctly, it will help you to increase the valuation of your company. So how does venture debt fit into the venture capital financing ecosystem? Venture capital is a term that's very commonly associated with venture equity. But within the whole spectrum of venture capital, that's both debt and equity. So let me explain a little bit, right? In the US in 2019, that's almost about 140 billion that has been injected into startup companies, right? And a big proportion of that is in the gray bar, which is venture equity. And about 20-30% of that comes in the form of venture debt. So think about that. The whole amount is actually very significant, right? So venture debt, the amount of venture debt that has been raised in 2019 approximate to about 20 to 30 billion. Southeast Asia, we are just at the beginning of seeing venture debt being introduced. And when I started the venture debt evolution in 2015, out of a $10 billion raise, venture capital raised by startup companies across this region, we're only seeing less than 1% of that actually being raised in venture debt. Okay, whereas what about the future for the next 5 to 10 years? There's certainly a lot of headroom for venture debt to grow. So there are a few reasons why startups do not seek debt, right? And they don't seek debt because there's a lack of awareness, right? I'm sure many of you on listening here on today does not know that there's venture debt available. Timing, right? When do you raise venture debt, right? When do I actually use debt, complement that to equity as well? The mechanics of how debt works. And the last but not least is very fearful, right? A lot of people think that debt will actually collapse the company. But if you can dispel all this myth, right? Venture debt can be a very powerful financing catalyst for your startup company. And venture debt is not very well publicized globally, but there's some estimates. And here's a study done by PitchBook in the US, a research firm. And if we look at the high and the low estimates, right? At the highest part, there's about 20 billion of venture debt activity that has been injected into companies, between 10 to 20 billion at any one point in time. Who are the venture lenders? Well, one very famous banking institution is called Silicon Valley Bank, right? They are right smack in Silicon Valley itself. And the name appropriately says that their target is mainly startup companies. They want to back the founders. They want to provide debt. They want to also back the investors as well. They are set up as a bank, but a very differentiated bank, right? This is a bank that understands the risk and the return profile of a startup company, and they are willing to put that capital at work. And then on the other side, Genesis is a private venture debt fund. So we are set up very similarly like a venture capital fund that you see across Southeast Asia and globally. We are an entrepreneur group of people. We saw the immense addressable market of venture debt available in Southeast Asia. We have dealt with entrepreneurs who suffer the market pain point of raising debt as well. And when we wanted to provide venture debt as an asset class, right, for investors out there. These are some of the companies that have decided to take venture debt from us. They like us not because we provide debt, but they like us because we are a value-adding venture investor as well. And there are many more companies that we are working on today, and we hope to see more of those logos appear on our website soon. Here's a very good case example of venture debt being used right in our backyard. Singapore-based Flow Technology. They're using artificial intelligence and machine learning to revitalize the whole act of debt collection. Right? I'm sure many of you will know that debt collection has a very bad reputation in this part of the world. But by using technology and leveraging technology to do debt collection, they hope to eradicate some of these unethical means of collecting debt. So let me give you a couple of examples, right, of how venture debt can be helpful for a company and how is it used. So imagine a company A wanting to raise about 10 million in the form of a Series B financing. 100%, if you raise 100% of 10 million at certain pre-money valuation, let's say, for example, company A gives away 25% of the equity stake. Now, look on the right side, right? So if you raise part equity, 7 million, part debt, 3 million, what company A does is that instead of giving away 25%, now it gives away 20% of the company, and 1% of that actually goes towards venture debt warrant option. And company A is now, say, 4%, right? So there's a savings in the form of equity dilution. Now, a second example would be the company manages to raise $10 million, but you want to leverage on that equity raise to raise more debt. So what will happen to the company? The company now receives 3 more million of cash in the bank, right? So 13 million instead of 10, and it gives away 1% more of the dilution to the venture debt warrant option as well. But think about it, right? Now the company has more cash in the bank, they can do more, they can accelerate faster, they can grow into 2 other more markets as well, they can introduce more products, and they can grow the company faster. They want to get to the exit point a lot more faster than a typical other company would do. So venture debt is not there as a standalone financing, it's a complement to equity, right? And the reason why that's a lot of interest in venture debt is also because it's a very good form of complementing and adding on that financing that you have brought into the company, right? And in COVID, I think a lot of entrepreneurs have realized the fact that venture debt is actually a very powerful form of financing that can complement and add on additional much needed financing into the company. So we have talked about, we're coming to the end of the presentation, and I'll get some of the questions answered later on. We've talked about the personal savings side. You have to have skin in the game, bring in some of your friends and families, crowdfunding, angel investing, equity, debt. This is the entire spectrum of the funding timeline for company, so be aware of that. And I just want to leave you with a bit of advice, right? So founders with ambitious aspiration need capital to scale, right? So no mistake about that. One thing is that money is very easy to find when you don't need it, right? So if a founder coming to me and telling me that, look, I have 3 more months of cash, I'll come in when I have about a month left of cash runway. Money is going to be extremely hard to find when you desperately need it, right? So this is the advice that I would give to any budding entrepreneurs who wants to go out on a fundraising journey. So that's my contact out there. We are also actively hiring internship as well. So please get in touch with me and my team if you're interested in joining us in the venture debt journey, or if you would like to raise venture debt as part of your financing mix as well. So with that, I will end the session. I thank you all for your kind attention, and have a good day ahead of yourself. Thank you.